Hey guys, Toby Mathis here, and today we're going to talk about 3 ways to be your own bank. Do you want to know how the wealthy skip the banks, avoid loan officers, and finance their own investments? I'm going to show you 3 ways to be your own bank, and these aren't gimmicks. These are strategies I've seen used by high net income people, my high net worth clients, business owners, and even myself. We've all used them. Now, I'm not saying you should never borrow from a bank again either. What I am saying is that once you understand these tools, you'll have more control, less stress, and possibly even tax benefits from using them. Let's break them down one by one, starting with the one that gets the most hype, and you guys know what that is, right? We all hear about it. Be your own bank, infinity in banking, whatever, or infinite banking. It's using IUL and whole life insurance. So let's start with the cash value insurance, and the code provision for this is Section 7702, meaning that there's an actual internal revenue code that allows these things to grow. They're available for index universal life and whole life policies, for example. This is the classic be your own bank strategy. In fact, when you see this, it's almost always an insurance guy schlepping the insurance. It was popularized by Nelson Nash in his book, and it's legit when it is set up right. And here's how it works. You get a life insurance policy that is a permanent policy, and you overfund the policy. In other words, you're paying more than just the cost of insurance. So you're putting in more than the base premium, and that extra builds cash value. So it looks kind of like this. You have what's called the death benefit and the cash value. And this is the secret sauce. This, depending on the policy, is either going to grow based off of the stock market, or it's going to grow from the dividends that's being created from the mutual company. Whatever, when you buy a whole life, you're getting that dividend, and it's growing tax-free. So the cash value is growing in a tax-deferred or tax-free manner because once there's enough in there, it just keeps growing and growing and growing, and then you could borrow against it. And I didn't misstate that. You're borrowing that out. And so the typical situation that people teach is, hey, let's do enough, let's put in money over the years, and they'll even finance the premium. So they get a whole bunch of money stuck in that cash value, and you want that cash value to grow, and then you borrow against the cash value. And all that growth is growing tax-free. When you borrow it, it's not taxable. And this is where it gets really fun. When you die, that's not taxable either. So you may never pay tax on this. So the money keeps growing as if it was never even borrowed. When you do this loan, for example, I might take this loan out. It might be at 4%, but my cash value is growing at 10%. You're keeping that spread, and you're taking this 4%, and what are you investing it in? You got it. You're putting it in things like real estate, your business, other investments. If you have credit card debt, pay that off, because chances are the interest rate paid here is going to be less. You're still growing the cash value, and you're making the spread. You're the bank. You're your own bank. You get to decide on the repayment terms, whether you're even going to pay it back. There's no credit checks. There's no loan applications. But this is crucial. You need the right type of policy. I see a lot of agents that don't set this up correctly, and sometimes they oversell it. They're trying to get massive commissions, and they're also incentivized to sell a higher death benefit when really what you want is that cash value to grow. Not all policies are created the same, so you really want to work with somebody who knows what they're doing, preferably a fiduciary, somebody who has a legal obligation to put your interests first so you don't get somebody that just decides they're going to target you and sell you a really huge commission product. You can usually tell by the cash surrender value, by the way. You look at those surrender values before you sign that policy, and you'll know what they're getting paid, because that surrender value, if you have to close down the policy, is going to be really low based off of what you paid, because you had to pay out a huge commission to the salesperson. So you want to be careful. You want to work with somebody that you trust. All right, that's number one. And that is the traditional be your own bank, infinite banking, whatever you want to call it. It is a Section 7702 that allows that to grow tax-free. And then if you pay it off when you die from the death benefit, it comes immediately pays that back. Even if you've never made a payment, or like a lot of people never pay these things off. They don't even make payments. So you get tax-free money throughout your lifetime. And then when you die, it pays it back, and those proceeds are not taxable. So you're getting a pretty good deal. You don't get a tax deduction to put money in. But as it grows, let's say this cash value grows at 10% a year. If it's tied to the market, that's what the market's been about. So let's just say, I think legally they have to show you 7%. So let's just say it's 7%, which means your money doubles every 10 years, rule of 72. So let's just say you put in $100,000 in a policy, and it grows over time, and it goes up to $200,000, and you borrow $100,000, $200,000 out. Well, you wouldn't be able to borrow the whole $200,000. It's going to be a portion. So let's say you borrow out $120,000. You get that out tax-free. When you pass away, that $120,000 gets paid back, and whatever the death benefit is, let's say the death benefit's $500,000, that difference is going to go to your family or wherever you direct it. So it's actually a really effective tool. But again, it's misused a lot. I use these because I want the death benefit. I also want living benefits. For example, if I get a life-threatening disease, I want to be able to access some of that death benefit before I die. I'm also using this, obviously, for the cash value, so I can actually borrow and not have to pay tax on that money. And if I need the money to go into a real estate project or something, boom, I have access to it. So that's number one. Number two, the second way, is borrowing from your 401k or a retirement plan that allows you to borrow. IRAs do not qualify. But if you have a solo 401k, for example, or you have an employer plan that allows borrowing, you can borrow, generally, it's up to $50,000 or 50% of your vested balance, whatever's less, you can borrow that out. And I know what you're thinking. Why would I take money out of my retirement plan? Because it's very similar to this. The cash value, in this case, let's just call it a 401k, it's growing. Again, let's just say you did SPY and it's growing at about 10%, and you have a 10% growth. When I borrow it out, I'm paying federal AFR rates, which I'll get to in a second. So you're just borrowing the money. You're not taking it out. This money, that $100,000 is still in there. You're borrowing $50,000 out, let's just say, because you can borrow half. There's still $100,000 in your account. You owe it $50,000. So you're just borrowing it. You're going to pay yourself back with interest, but it's low interest. So for example, right now where I'm standing, it's a little over 4%, while your typical mortgage is 7%, and a typical credit card is in the teens. So your 401k earns interest from you. You're the bank and the borrower. This is great if you have short-term capital needs, if you're doing a real estate deal and you need cash to close, or you're paying down high-interest debt. Like if you have credit cards and you're paying double digits, you are crazy not to do this to pay that off. But if you borrow from your 401k, you usually have about 5 years to pay it off. And no, it does not trigger taxes or penalties like a distribution would. So for solo entrepreneurs or small business owners, this is an incredible liquidity tool. All right, the third one, the third area where we just covered, be your own bank with insurance, use your 401k. What's the third one, Toby? It's borrowing from your own business. If you own a closely held business, it could be an S Corp, a C Corp, it could be an LLC. Your company can lend you money. Your LLC could literally lend money to your company. And here's why it's awesome. Because the business earns interest income. You potentially get a deduction for the interest you pay, and the money stays inside your ecosystem. In other words, it doesn't leave your realm. Plus, I'm an asset protection attorney too. I'm a tax guy, but I also spend a lot of time on asset protection. Say you're doing some hard money lending, or you're doing something active like you're flipping a house. You could use, let's say, a Safe LLC. Let's say we're doing Wyoming LLC. We use Wyoming because it's anonymous, it's protected, and safe. Let's say that we loan it to your corporation. You can do that. We're going to charge federal AFR rates because it's a related party transaction, or at least that. So it's going to be market rates, but this is generally right around 4 to 5%. Then that corporation, let's say it's doing hard money, it might be making 10% on that, and it keeps the spread. Maybe you're doing a house flip and you're hoping that you're going to make a nice return. Let's say you want to make 15 to 20% on that flip. You now have the ability to secure that money. The business, which has the risk, well, it has the loan. If the business fails, you can secure these loans so you're still protected. It keeps your money out of the line of fire. No matter what you do, and I'm just going to say this, no matter what you do, you still got to do it right, which means you draft a real promissory note, right? And you charge interest. And you make a payment schedule so you're paying it. You treat it like a real loan, because if you don't, the IRS can say, hey, it's a disguised distribution. If it's a corporation that's loaning you money, for example, you got to dot your I's and cross your T's. You want to talk to somebody. Make sure that you talk to us if you have any questions. Now, this is one of the more effective ways to use money, especially if you have a high liquidity business, or if you have a safe. I call it a virtual safe. I always like to use these to save my non-risk assets. It's a great way. Like, for example, I could be using this on all my real estate because I can create a friendly lien against that real estate, and it's a great asset protection tool. So it's just a very, very effective tool for a number of reasons. But you got to have those businesses to make that work. You can't do it with just yourself. All right, let me go over some bonus options, because there's other ways that you can access money where you can act like your own bank. A lot of you guys have a lot of equity in your house. You're going out, you're trying to get a business loan, or you're trying to get a loan on a piece of real estate when you already have a house with equity in it that you could access. You could do like HELOC. There's a company, I think it's figure.com, I used once. Literally, it's AI driven, and it'll give you money. I think I got money in 48 hours. I wanted to see how quickly it would work. Didn't have to talk to a loan officer. They just verify the money that goes into your bank account and title. And once they see that, and they see you have equity, and they run an algorithm, they just give you the money, and it's quick, and it's pretty inexpensive. So you can borrow from your own home if you need to get access to money, rather than trying whatever it is that you're trying to use the money for. Sometimes it's difficult to get it qualified. For example, if you're doing a business startup, or if you're trying to buy an investment property, you're sitting there trying to figure out the rent rolls or something. Maybe the property's never been rented before. You got to jump through a bunch of hoops. It's easier just to use that HELOC, a home equity line of credit, borrow against your house, and buy it. And no, you don't have to you're not writing it off as though it's the interest exclusion on your Schedule A, right? We're not writing this off to say it's, hey, I get a mortgage deduction. No. Because this is, if you're using that HELOC for an investment, then it's deductible as an investment. The interest is an investment loan. So you get to deduct it against the income that's being derived from whatever that activity is. So it's not treated as though you have to write it off individually for your mortgage interest deduction. You don't have to worry about that. It's an investment, so you're still writing it off on the investment. There's another type of line of credit that people don't realize that they have access to as well. It's called a security-backed line of credit, SBLOC, security-backed line of credit. And what that is if I have a security portfolio, a blue chip portfolio, I can borrow against that. I do this with my portfolio. I actually bought a commercial building once, got into a bit of a war. There was two other parties that really wanted it, and I wanted it. It was in this perfect spot for what I was using it for. So I said, cash, 7 days, close. I was able to do that because I didn't have to worry about financing. They're all financing through a bank. I just went against my securities account, and I said, hey, it was really low. It was like I had a fixed interest rate around 5% when everybody else is paying 6-7%. Morgan Stanley is who I use, and I just borrowed against it. Immediately, was able to use it to buy that building, and was able to get cash, within 24 hours. So it was a great situation. A lot of times we don't realize we have access to these things because we have other investments. So if you have a portfolio that have good blue chip stocks and bonds and things like that, you could probably borrow against it. You may not even realize this. Talk to your brokerage. I have multiple brokerage houses. I know that Raymond James does it. I know that Morgan Stanley does it. Most of the big brokerage houses will do a security-backed line of credit. You want to have it in place before you need the money because, again, you still have to jump through a few hoops when you've set it up. It's very quick, and because the asset's sitting there, it's very easy to get access to. You may even have one, you don't even realize it. You may already have it set up, you didn't even realize it. You'd want to talk to your broker about that. So the big three that we talked about in the very beginning was the life insurance, becoming your own bank, the 401k loans, borrowing against your own retirement account, and the business lending. But here's the bottom line. The wealthy don't just save money. They circulate it. They use it to put it into other things. In fact, there's a great quote, and you could steal this just like I am. Money is like dung. Leave it in a pile and it stinks. Spread it around and everything grows. If you want to learn more about these kind of strategies, hit that like button, subscribe. And if you want to, you can always go into the comment section and just type in consult, and somebody will reach out to you. If you want to talk about any of these strategies with a professional, you could absolutely set up a no obligation free meeting and we can talk about whether any of these strategies will help you. I'm Toby Mathis, and as always, make smart decisions and keep more of what you make in your pocket.